Happy Thursday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Thursday, August 22nd, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to stay on the right side of market risk, you need to be a client of 42 Macro. So today's key macro questions are, where is the global economy headed? And will the Fed acquiesce to a weak dollar? Our answers are, the latest leading survey data are generally supportive of our green shoots globally theme. Recall that the 42 macro grid model is calling for bottom-up macro regime Goldilocks for the majority of economies in the world through year end. That's growth trending higher, inflation trending lower. That is divergent from our U.S. projections of deflation followed by inflation. Deflation, if you recall, is growth trending lower and inflation trending lower, whereas inflation is growth trending lower and inflation trending higher. Historically, the U.S. dollar has been a key ingredient in the global economy decoupling from the U.S. economy. The Fed, Treasury, BOJ, and PBOC all have key roles to play in this cycle with respect to perpetuating dollar weakness. Refer to our August 2024 macro scouting report and our August 10th and August 17th around the horns for more details regarding our bearish outlook for the U.S. dollar. The July 31st Fed meetings were supportive of consensus calls for imminent start to policy normalization. Yesterday's annual benchmark payrolls revision was supportive by reinforcing the narrative that the labor market was on softer footing. And with respect to that, before we transition to our 42 macro dashboard, I'll say, even inclusive of the payroll revision, I want to say it's down 818,000, from the prior estimate in the year through March of 2024. Payroll still grew 1.3% in that time period, so that it was revised from a projected growth rate of plus 1.9% down to plus 1.3%. So be aware that payrolls actually grew. They obviously didn't grow as fast as the initial estimates suggest, but the labor market was obviously still remaining resilient throughout that time period. And so even though if you look at the bear porn out there on Twitter and whatnot, there's, oh my God, 1 million jobs have evaporated. Fine, whatever. That is true. But what is also true is that folks like us and our clients who've been making money on the long side of this raging bull market, their returns did not evaporate. And so I just want everybody to let that sink in and remind you that you don't get paid in units of I told you so with economic statistics. You get paid by the momentum of asset markets. And respect to the momentum of asset markets, that's a perfect transition to our 42 macro dashboard, because we got a question here from our community underlying that, or at least the answer to the question is underlying that. So this one's regarding Dr. Mo comparative analysis. It says, I've been wondering if there's a comparative analysis of following Dr. Mo versus a simple buy and hold for Bitcoin. I see the chart that shows Dr. Mo. Dr. Mo is pretty good at maximizing upside capture, but just wondering if there's more analysis somewhere, i.e. you could have realized X by following Dr. Mo in a particular time span. Anybody know? So yes, that analysis exists. It's in every single piece of 42 macro research in terms of our global macro risk matrix back test for the various asset classes. We have all the asset classes here on slide 16 of today's leadoff morning note. And then with respect to Bitcoin specifically, as you can see here, Bitcoin, the percent of cumulative performance. So let me take a step back for those who may not be familiar. Dr. Mo is our discretionary risk management overlay. It is the quantitative risk management system that we use to keep professional investors and sophisticated retail traders on the right side of market risk. What Dr. Mo does is it infuses together our top-down market regime with our volatility adjusted momentum signal condition for all the assets in the world, all the major assets that are traded in the world, and it spits out a proper trade recommendation based on the interplay between the current market regime and the current volatility adjusted momentum signal condition for a particular asset. So if you go back to this back test here, if you were only long Bitcoin when our discretionary risk management overlay, when Dr. Mo said we were in a risk on market regime, you would have had more than the cumulative performance in the entire Bitcoin asset class that has been experienced to date. So, for example, that's 109% of the cumulative performance in Bitcoin since the beginning of the asset has come when our market regime nowcasting process, aka when Dr. Mo has signaled we are in a risk on a condition. And so, obviously, what that means in layman's terms, if Bitcoin, let's say Bitcoin went up 100%, just using round numbers, since its inception, you would have gained 109% return instead of just that 100% return because you were respecting the evolution of the Dr. Mo signals. Whereas if you were long Bitcoin in risk-off regimes, you would have actually lost money throughout that entire process. So It's an impressively powerful tool. Our discretionary risk management overlay, aka Dr. Mo, in terms of keeping clients on the right side of market risk, an incredibly easy tool to use. It tells you exactly what you should be long and short at any given time, and how much to be long and short that particular asset at any given time. And going back to the question, I think it's really important to remind investors of one particular subject. On this chart on the screen here, one particular subject that is near and dear to my heart, but is unfortunately not very discussed, not widely discussed, and ultimately it's not something that the average, certainly retail investor is aware of, but obviously professional investors are well aware of this. But if you're a retail investor, you probably have no idea what volatility drag is. And that is an issue for you and your family, because volatility drag is arguably the most important thing in investing that nobody talks about. And I would argue it's probably one of the more important dynamics in investing beyond compounding returns, but it obviously builds on the concept of compounding returns. So in this chart here, where we show, kind of we kind of use this as an illustration to teach people what volatility drag is. Both of these investment strategies, the blue and the red one, feature identical 50% average annual returns. Which one of these investments would you choose? So you start with an initial $100 investment, and after year one, the blue investment grows to 150. And the red investment declines to 50. After year two, the blue investment has grown to $225. The red investment has grown to $100. And after year three, the blue investment has grown to $338. And the investment strategy B has grown to $200. So which of these investment strategies would you have? Would you rather have the blue investment strategy A or the red investment strategy B? Again, they both have the same exact average annual return of plus 50%. And see, this is exactly the point I'm trying to make, is that obviously if you knew better and could do better, which is what Dr. Mo allows our clients to do, you would obviously choose investment strategy A, because you wind up with more money at the end of the lifetime of the holding. And so that's the whole point of compounding returns, using proven quantitative techniques like our global macro risk matrix and our volatility adjusted momentum signal that are infused into our discretionary risk management overlay, aka Dr. Mo, using those types of tools to make sure that your portfolio looks like investment strategy A as opposed to investment strategy B. The folks on Twitter who want you to be irresponsibly long things like Bitcoin at all times don't understand volatility drag. They don't understand that if you buy a bunch of Bitcoin right before it gets cut in half and it rallies a bunch from there, that you might still wind up with the same percentage return, but you wind up with way less money. And at the end of the day, investing is about making money. Make money. Don't be right. Make money. Shout out to our friend Mike Taylor for that wonderful quote from his many years on the buy side. So I think this is a good place to wrap up, but I just want to make sure that this is a very, very important topic. You need to compound returns. And in order to compound returns and maximize upside capture in bull markets and minimize downside capture in bear markets, you need to get out of the way and get to safety before big drawdowns, in so much that you need to get back in after big drawdowns. And that's exactly what our discretionary risk management overlay, aka Dr. Mo, does at an extremely high level for our clients. And so we're really grateful for that. We're really grateful for our clients. I'm really grateful for you for tuning into these every day. So have a wonderful day. We'll catch you back here tomorrow. Best of luck out there. Cheers.